How are you, folks? Enzo DiCassinzo podcast. This is our second video on monetary policy and fiscal policy. So we stopped here yesterday, and we're going to pick up where we left off. A little bit of a comparison now. Monetary policy and fiscal policy refer to the two most widely recognized tools used to influence nations' economic activity. Monetary policy is concerned with the management of interest rates and total supply of money in circulation is generally carried out by central banks. Fiscal policy is a collective term for taxing and spending actions of the government. In the United States, the national fiscal policy is a term by the executive and legislative branches of the government. That's a nice, as again, answering the question of, what's the difference kind of a question. That's pretty good. Interest rates and money supply for monetary policy and taxing and spending actions of the government for fiscal policy. These are macroeconomic tools used to manage or stimulate the economy. Monetary policy addresses interest rates and the supply of money in circulation, and it's generally managed by the central bank. Fiscal policy is addressed by or addresses taxation and government spending, and it's administered by the government, the governmental legislation, by the Congress and the executive branch. These have tremendous influences over the economy, its businesses, and obviously the consumers. The biggest piece of the economy. Central banks typically have used monetary policy to either stimulate the economy or check its growth. By incentivizing individuals and businesses to borrow and spend, the monetary policy aims to spur economic activity. Conversely, it can restrict spending and incentivize savings. It can act as a brake on inflation and other issues associated with an overheated economy. Okay, so those are the two pieces here. These should be on two separate lines like that. One incentivizes and one restricts spending. Or what it's incentivizing might be slightly different. Federal Reserve, which is the U.S. central bank, uses three different policy tools, and we've discussed these previously: open market operations, changing reserve requirements, and setting the discount rate. Okay, so we have a little bit of the definitions of these here. These are open market operations are carried on a daily basis. They're U.S. government bonds, and the central bank buys and sells to either inject money or to pull money out of circulation. This is the printing money operation of the central bank. They keep hearing on Fox News. The reserve ratio is a percentage of deposits the bank has to keep in reserve. In other words, this limits how much the commercial banks can loan out because it's got to keep more capital in their account and not lend it. And of course, this influences the money created when the banks make loans. And then the discount rate is sort of almost the price tag of moving reserves around the system. So the discount rate is what commercial banks would pay to borrow from the central bank directly. The federal funds rate is the one commercial bank versus another. It's supposed to impact short-term interest rates across the whole entire economy, and there's a trickle down into credit, into mortgages, into all sorts of products that certainly rely on interest rates. Monetary policy is a bit blunter. It expands and contracts money supply, influences inflation and growth, has less impact on the real economy. All right, the Fed was aggressive during the Great Depression. Its actions prevented deflation and economic collapse, but did not generate significant economic growth to reverse the lost output of jobs. So in other words, monetary policy is a little bit more of a backstop, like in a baseball field. Where the catcher sits, and behind the catcher there's that wood. At least maybe not in major league stadiums, but in most ballparks, little league ballparks, there's a big piece of wood behind home plate. That's considered the backstop. So the ball's supposed to bounce off that so it doesn't just keep rolling down the street or something like that. So again, people with little league baseball experience, you'll know what I'm talking about. So that monetary policy is that ultimate barrier type thing. You can have expansionary monetary policy that can have limited effect on growth by increasing asset prices and lowering the cost of borrowing, making companies more profitable. Okay. Again, because you have lower interest rates, lower cost of borrowing, lower interest rates, also limited effect on the growth of by increasing asset prices. Well, now prices can move up because of activity. Generally, a lower interest rate results in higher prices. A higher interest rate, there's less economic activity, and that less buying and selling creates a lower price. Okay. Monetary policy seeks to spark economic activity, when fiscal policy seeks to address total spending and the composition of spending, or both. Fiscal policy, generally speaking, the aim of the most government fiscal policies is to target the total level of spending, the total composition of spending, or both in an economy. The two most widely used means of affecting fiscal policy are changes in government spending policies and government tax policies. The government believes that there's not enough activity in the economy, it can increase the amount of money it spends, often referred to as stimulus spending. If there's not enough tax receipts to pay for spending increases, the government borrows money by issuing debt securities such as government bonds, and the process can accumulate debt. And I think we discussed this in class, where if you go back to the Bill Clinton years and just add up all the annual deficits, you should get to about 30 trillion that we are today. Because the last time that I remember the budget was bounced was most likely before most of you were even alive. Clinton got out of office in 2000, right? Because he got elected in 92, and he was a two-term president, so he was there for 8 years. Fiscal policy generally has a greater impact on consumers than monetary policy, as it can lead to increased employment and income. By increasing taxes, the government pulls money out of the economy and slows business activity. And also, the government decides how, by increasing taxes, the idea is the government will decide how to redistribute the capital, as opposed to letting the market do it, which is not as good of an idea. Fiscal policy is used when the government seeks to stimulate the economy. It might lower taxes or offer tax rebates in an effort to encourage economic growth. Influencing economic outcome versus fiscal policy, or via fiscal policy, is one of the core tenets of Keynesian economics. Again, the whole idea with Keynes is you spend based on your income. That's the idea with Keynes. When a government spends money or changes tax policy, it must choose where to spend or what to tax. And doing so, the fiscal policy can target specific communities, industries, investments, or commodities to either favor or discourage production. Sometimes its actions are based on consideration that are not entirely economic. There could be political slants to things, which certainly now is hotter than ever, for better or worse, right now, right? I'm just cleaning this up a bit. Basically, a government is targeting aggregate demand. Companies also benefit as they see increased revenues. If the economy is near full capacity, expansionary fiscal policy risks sparking inflation. This inflation eats away at the margins of certain corporations and competitive industries that may not be able to easily pass on costs to consumers. It also eats away at the funds of people on a fixed income. And those are two big issues right there. Okay. So the government, when there's already inflation, the government spends more. You're just exacerbating or increasing that inflation, and expanding, and also the people, the firemen, the gas and electric workers, the people on fixed incomes. Those people, hate this. Where we are now is just the kryptonite for people on fixed incomes. And lastly, fiscal monetary policy play a large role in managing the economy. Both have a direct and indirect impact on personal and household finances. Fiscal policy involves tax and spending decisions set by the government that will impact an individual's tax bill, provide them with employment from government projects. Monetary policy is set by the central bank and can boost consumer spending through lower interest rates that makes borrowing cheaper on everything from credit cards to mortgages. Okay. I knew today's lesson was going to be short, so this is what we hit today. All right, the third one is going to be pros and cons. Yeah, we're not going to hit this today, but this was for the assignment, the groups that had the fiscal monetary policy assignment. You've had this, and I'm just as we're sitting here saying. Guys, just give me a second. I'm just checking my 622 for a second. One, two, three is qualified investor. Okay, this is coming though, so. Okay, let's go to so this is coming. This will be the third video, maybe even tomorrow. We'll hit this one. That's a little bit longer. And what I'd like to finish off today is the Excel here. This is the current receipts model. Oh, we got to get the data in there. So let's look for table. There it is. So let's look for the expenditures part of this. So subsidies, persons, rest of the world. Okay, so again, in terms of subsidies, we're at about 150 billion or so, 100 billion. Interest payments that we're making. We want the black. That's just the summation of just the two that are below it. Interest payments to persons and businesses, and to the rest of the world that the government makes. Other current transfer payments, social benefits. This is summing persons, government social benefits to persons and the rest of the world, almost 4 trillion. And then the current transfer payments are up here. All three of these, 3958. And then the current the consumption expenditures are here. Right there. Okay. So now your current expenditures is just a summation of all the blue inputs. That one, this array, that next array. Okay, so the expenditures are 8984. Yeah. All right. That's your expenditures. It's all these arrays added up, consumption expenditure. And again, you can go, to the uh, government social benefits or whatever. You can go to the website, to the glossary, and we'll quickly do that one more time. There's transfer payments, government current receipts, government current expenditures. And again, it tells you everything that's involved in this. Government consumption expenditures, current transfer payments, interest payments, subsidies. The receipts are, again, we looked at this the other day. Okay. Current tax receipts, current surplus of government enterprises, plus or minus. Here's government social benefits from the government social insurance funds and from certain other programs. Okay. That's government social benefits. And like I said, and that's Mozart. You could go through everything here if you wish, all these definitions, and you should do that. Now, the net government savings number equals the receipts subtracted from the expenditures, and we know this is going to be negative because it's, obviously we knew ahead of time we were going to be negative here because expenditures were bigger than receipts. Yeah, 129252. Okay. And we still have a little more to go here at the bottom. And actually, this is 2022, so we're going to move all this stuff to the appropriate sort of neighborhood, but just hang on for that. And then some other classifications to get this net government savings, social insurance, and others. So as you can see, if you can just add these up. All right, it's the same number. Oops. See, now these are the same numbers. So all we did was we took social insurance funds and other. Yeah, this is just a classification here, breaking up social insurance and non-social social insurance funds is what was done here. As you can see, you could just do a quick check. Right, those are the same. And then the addenda, you have current receipts and current capital transfer receipts. Again, another way to compute the transfer receipts. But as you can see, the numbers are slightly different. Okay, so this is just other ways of classifying some of these numbers. That's all this is. And then total expenditures, and we'll get to that. So for this other stuff, this is current expenditures, net, all these guys. and this capital consumption of fixed capital. I guess that's the depreciation number. And you guys remember we spent a lot of time on depreciation this semester. And this is just a sum of all of these. Zero, 91 cents. Yeah, good. These are all the same. And then the net number is simply these two minus yeah, these are about the same. So 1, 4. Yep. Okay. Net lending or borrowing. So these are just different classifications of the same ledger here, right? You have those receipts, which are there, expenditures, expenditure, gross government investment, capital transfer payments, non-produced assets, and then less consumptions, obviously depreciation. That's a big number, right? 700 billion is a big number. So, okay. So, and also now this is not 2012's numbers. So what we'll do is we'll say copy here, and we'll go all the way to, if these are 2022's numbers, we'll just drop them in there. And when these things bunch up like that, that top line number, just open them up like that. Okay. There you go. Now you see tax receipts, the total government tax receipts, the total government current expenditures, the total government expenditures, and you see what all that looks like. Okay. And when they're talking about balancing budgets, you get the magnitude of these numbers, which is really gigantic. Okay. Yeah, today was short. I know today wasn't a very long lecture, so we'll pick up next. I did a bunch of short lectures instead of just a big long one. So yeah, we don't need the tables anymore. Let's get rid of tables. Don't need, save that. So the next lecture, and this is on the this would be on the exam. So yeah, the assignment. Now this is the fourth for the undergraduates. This is the fourth assignment. So the pros and cons is a big part of that. And then we have, we're not doing FDIC. It'd be good to do federal, but I don't think we'll have time for central banking and the central banking stuff. And also, since we have a few minutes here, let's just show you guys how I sort of move things around. Monetary Control Act is right there, which is important what the central bank is. Here it is, fiscal policy. What is fiscal policy and monetary policy? See, so I moved a big piece of it. Monetary policy, fiscal. Okay, we got all that stuff. And we're here with this. So what we'll do is we'll put the labels up there. We'll cut that. There, that's how you keep what you're doing organized. And these are all 14s. Okay, that we don't need. Okay, that's it. All right, we'll pick up tomorrow with the pros and cons version of this. 119, right? Page 119 tomorrow, and that'll be the third video for the week, and that'll be just a discussion tomorrow on that. Okay. Thank you, folks.